Hello again, traders. Doing job there from DRFX, Swing Trading Mentoring. Going to be taking a quick look at a recent trade that was made on the Euro-Japanese Yen, which provided us with a strong gain of 100 pips as we took advantage of the formation of the range setup on the daily chart of this currency pair. Now here you can see the graph which summarizes the result of the trade. 100 pips from the short position on this currency pair, which hit our target in just over 18 hours. And for me, this represented a trading gain of just under 5% from this single trade. And here you can see the rate of return so far with the combined trading approaches that I've been using since February. Just under 13% rate of return. And as you will see in a moment, this has just come from 8 trades and only 2 losses. The combined approaches basically target 50 to 70 pips within a 24-hour trading period, as well as up to 100 pips within 2 days. And here you can see the graph of the result on my live account with FX Pro, where the market declined sharply to the 100 pip target as part of the breakout that took place from the consolidation setup on the 4-hour chart. And here you can see the summary of the trades that have been made so far since the start of these 2 trading approaches in February of this year. 8 trades made, with the latest coming, as you can see here, from the Euro-Japanese Yen, 100 pips, with a 4.89% rate of return from that trade alone. And so what it is showing is the accuracy of the combined strategies that have been able to provide this large rate of return in just 3 months and from just 8 trades. If you're a subscriber, you would be familiar with this email that was sent just before the trade, which essentially justified the trade itself, providing summaries of the overall setup on the daily chart and the 4-hour chart. And here you can see the email alert that was sent to me from my FX Pro live account to indicate that the trade had reached its target and had captured the trading gain as predicted. Now to the trade itself. Now, as you know, I use FXCM trading platforms to provide me with market direction and entry signals, because that platform provides the best representation of the New York close of the daily candle, which is crucial to trading strategies like mine. FX Pro and other trading platforms also use this candle, but I found over the years that for some reason, FXCM seems to provide the best representation of this candle. So as you can see here on the daily chart, what was taking place was that the market was gradually forming a range consolidation setup with a support boundary already formed, and the market now U-turning to provide another downtrend that would allow us to complete the formation of the overall range setup. So the single candle was given to indicate the continuation of this movement, as well as to indicate that we could start trading short by looking for setups and signals on the 4-hour chart. Here you can see on a 4-hour chart where the market had formed a range consolidation setup, and what was taking place was that the U-turn that we saw taking place on the daily chart was created by this false breakup reversal that took place on this time frame. As you can see here, the market attempted a bullish breakout initially above resistance, but this was short-lived as the market U-turned aggressively to head back inside of the consolidation and start a downtrend below support in favor of the Japanese yen. So the setup on the 4-hour chart was a downtrend as part of a false breakup reversal, providing us with this counter trend line setup, as well as this downtrend line that could be used to protect our trade as we aim for our trading target. As you can see here, this was the trade setup to take advantage of this expected decline. Stop loss placed just above the downtrend line, with entry taking place at the close of the candle, and the target set for 100 pips at the 130.29 level. And as you can see here from the result of the trade, 100 pips were captured in just over 18 hours. And this took place despite the temporary spike that threatened the position somewhat. But because of how far our stop loss was above the downtrend line, this was never going to be threatened. And eventually, as you can see, the market eventually continued the bearish momentum, U-turning sharply and declining as expected to hit our trading target. Now, one of the technical theories that were involved in this trade was that of a bear crown setup, otherwise known as a head and shoulders pattern. This is a very common pattern when it comes to trend reversals. And as you can see here, this was actually one type of bear crown setup where instead of having the left tip, the center tip, and the right tip, the market created the center tip, the left tip, and is expected to continue this reversal without a right tip, which is something that happens from time to time, where the market simply continues in this new trend direction with single candles. So instead of forming a right tip to create the perfect bear crown setup, the market simply created a left tip, the center tip, and a fairly strong U-turn to change trend direction and to provide us with this new direction for the currency pair. Now here you can see a typical example of the quote-unquote perfect bear crown setup, where the market creates a left tip, center tip, and then a right tip in the form of a counter trend line setup, or perhaps maybe a small consolidation setup in the new trend direction. So when the market is about to change its trend direction, it will form one last setup as part of the previous trend. It will then continue in that previous trend direction temporarily before U-turning to start the reversal, breaking trend lines that have been formed along the way before starting the new trend direction. And in starting the new trend direction, the market will create its first setup in the form of a counter trend line setup or a consolidation that would create the right tip and continue the movement in the new trend direction. But as I said before, there are times when the market does not form the right tip and simply forms single candles to continue the movement in the opposite direction. Now, another theory that was in place for this trade had to do with the ability to identify the formation of consolidation setups. What I found is that the market provides us with certain types of waves that indicate that the market is going to be forming either a range consolidation setup or a pennant consolidation setup. In the case of the Euro-Japanese yen, it was a range consolidation setup. And essentially what we have to do is to identify the types of waves that tell us when the market is likely to be forming these consolidation patterns. Once we're able to identify them, we can predict the type of formation that is going to be formed. And once the signals that are given as part of the formation are strong and clear enough, then we can take advantage of them by trading these movements for strong trading gains instead of waiting until the market has formed a consolidation setup and then trading. So it allows us to take part in the formation of the setup as well as to continue trading once the setup has been formed, as well as to trade the breakout when it finally takes place. Another important element that was seen in the trade has to do with false breakout reversals. These are situations in which the market attempts to break out in one direction from the consolidation setup and is then thwarted by a sharp reversal that takes us back inside of the consolidation. These are the three most common ways in which the market can start these reversals: double bottoms, ABC signals, and small consolidations that get things going in the opposite direction. And of course, there's a fourth way in which the market can start the reversal, where the market simply U-turns with an opposing candlestick formation that takes out the initial attempt to get things going in this case bearish, by providing us with an opposite candlestick signal, in this case a bullish signal, to take us back inside of the consolidation and start the breakout at the other end of the consolidation. So in the case of the Euro-Japanese yen on a 4-hour chart, what we saw was the opposite taking place, where the initial attempt was a bullish movement, followed by a sharp reversal that took us back inside the consolidation. So this was one of the theories behind what took place on the trade, in this case what took place on the 4-hour chart. So this trade was a very good trade, 100 pips in a very short period of time, and it basically showed us how we can take advantage of the candlestick patterns that the market provides us that tell us where the market is headed and when is the ideal time to take advantage of these movements for strong and consistent trading gains.